Why do we invest? What makes us wealthy? Throughout history, investments have been described in terms of the income they produce. It is an investment's income-generating capacity that drives both its economic value and, ultimately, its market price, not the other way around. But a huge competitive money management industry requires simple yardsticks for firms to use in showcasing and comparing their investment performance. Thus, market price appreciation and growth have become paramount, even though they are less important to individual investors, for whom the size of their income stream is more meaningful than whatever price Mr. Market assigns to the source of that income. Fortunately, retail investors do not have to fall for the drumbeat message from the financial media and professional investment community that market price appreciation is the quintessential goal. We developed the Income Factory as an alternative that allows investors to focus on building and capturing the economic value of their portfolios, irrespective of whatever price Mr. Market chooses to assign to them from one day to the next. Why dividend investors should look at free cash flow. If you're a dividend investor, I think you should pay more attention to a company's free cash flow than its earnings. In a nutshell, here's why. Dividends are paid out of cash, so we need to make sure a company is consistently generating more than enough free cash, i.e., spare cash, to pay the dividend. Key point. If a company has made large acquisitions in the past, its reported earnings may be significantly reduced due to the non-cash expense of intangible goodwill amortization. In these cases, free cash flows can be a much better guide to the safety of the dividend than earnings. My second example will focus on a company which has the opposite problem, i.e., its free cash generation is much lower than its reported earnings. Key point. If a company is growing rapidly, its capital expenses may be much larger than its depreciation expenses. This can result in free cash flows being much smaller than earnings and possibly even negative. If free cash flow consistently fails to cover the dividend, it could be that the dividend is being funded by debt, which is almost always unsustainable over the long term. Stocks with a higher free cash flow yield provide higher returns. With high free cash flow possibly indicating a strong, healthy balance sheet, we tested to see if free cash flow yield, defined here as annual free cash flow per share divided by stock price, contains any meaningful return information. Our investment thesis is that all else being equal, a company with a higher free cash flow yield will deliver higher free cash income for each US dollar invested and is preferable to one with a lower free cash flow yield. We divided the S&P 500 universe into quintiles based on free cash flow yield. As shown in Exhibit 4, the top quintile stocks generated an annualized return of 15.7% from December 1990 to June 2017, exceeding the rest of the quintiles and outperforming the overall market by an average of 3.6%. Although the bottom two quintiles demonstrated sound performance, with average annualized returns of 11.0% and 8.6%, respectively, they both fell short when compared with the overall equity market.